Good afternoon, everyone, and welcome to Carrick Wealth's quarterly market outlook webinar. My name is Rashay Makan, Managing Director of Carrick Wealth South Africa, and it's a pleasure to have so many of our clients and partners joining us today. These sessions obviously form a key part of our commitment to clarity, transparency, and proactive communication, especially in a global environment where markets can shift rapidly. As your wealth management partner, our role is not only to build robust long-term strategies, but also to continuously interpret the evolving economic landscape and ensure your portfolios remain well positioned for the road ahead. Today's session is particularly valuable as we're joined by a very familiar and highly respected voice in our ecosystem, Nathan Sweeney, Chief Investment Officer of Marlborough Multi-Asset Funds. Marlborough is one of Carrick's most trusted global investment partners, and many of you invest across their multi-asset solutions. Nathan and his team play a central role in navigating the balance of risk and opportunity across asset classes, ensuring that portfolios remain resilient, diversified, and positioned for long-term growth. Over the past quarter, we've seen a fascinating mix of themes emerging across global markets. Shifting expectations of interest rate cuts, the continued evolution of the AI-driven equity rally, geopolitically induced volatility, and signs of divergence between major economic regions. Against this backdrop, Nathan will provide a comprehensive review of the quarter, discuss the major forces shaping global markets, and share his outlook for the months ahead, including what that means for your investments held through the Marlborough funds and broader Carrick portfolios. So without further ado, it's my pleasure to hand over to Nathan Sweeney. Nathan, thank you for joining us once again, and we look forward to your insights.
Just getting the unmute button there. Rashay, thank you very much for inviting me along today, and yeah, a pleasure to give everybody an update on what's happening in markets. So again, it has been another whirlwind quarter. But first, I'm going to start off with some performance. So if I start off with the performance of the funds, you can see that over the last 3 months, performance has been quite strong. So you've had 8% performance for the adventurous fund down to 4.6 for defensive. And year to date, that puts us in quite a good position with performance of 14% ranging down to 8.4%. So we are pleased with performance given the roller coaster year that we've had. And it just goes to show you that often you can get instances throughout the year where markets react and then they can move higher as well. So I think Liberation Day would be a really, really good example of that, where a lot of people were probably really concerned about, the trajectory for the rest of the year. And then obviously we've moved past that, and earnings have come through from some really good companies. And this is just giving you that performance just looking over a discrete period. So it's showing you the 12-month rolling returns. And again, you can just see the performance over the various different time periods. And then we also like to show it versus risk. So ultimately, there's 4 different portfolios. And as you're taking or investing in a higher risk portfolio, you would expect to see higher returns. And that's what we're demonstrating. So this is looking at the actual performance delivered and the risk for investing in those portfolios. But what I want to focus on here is a little bit of the contribution to the returns. So this is just showing you where the returns have come from within the portfolios. And it's pretty much the equity side which has been leading the way. So we've seen really strong performance coming through from US equities. And post-Liberation Day, the market has performed pretty well. And over the third quarter, we've seen some good numbers coming through. And that's really been driven by company earnings. So the earnings coming from US companies have been particularly strong. And that's been driven by lower inflation. So it just means lower input costs for companies. And, you're also seeing that there's been little impact from inflation. Everybody was expecting maybe higher inflation post-Liberation Day. If we have these tariffs, do they increase inflation? And that hasn't been the case. So low inflation has also helped, those earnings to come through much better than expected. And if we kind of drill down on the next slide, it just gives you a breakdown of some of the contributions there. So we have a fund which tracks the performance of US companies. It's called the Spider S&P 500 ETF, which has done particularly well. But it's interesting to see that Asia has also performed quite strongly. And there's a couple of reasons for that. So this is the M&G Asia Fund. So if you look at Asia, you've got a lot of tech within the Chinese stock market, and some of those tech companies are competing really well with some of the biggest and best US tech companies. So you're seeing people actually recognizing the breakthroughs that some of those companies have made, particularly in AI, and the share prices have been rising as a result. Interestingly, for fixed income or bonds portion of the portfolio, not too much activity, but we do believe that that is likely to change as we move into 2026. And the reason we think that changes is because we expect to see more interest rate cuts, which generally benefits the bond side of the portfolio. And just a little bit on portfolio activity. So just gives you a look through on some of the changes that we've made throughout the quarter in the portfolios. So one thing we did was we actually hedged some of the US equity exposure. So a lot of people will be fully aware that the US dollar has weakened throughout the course of this year. And if you look at our portfolios, they're globally leaning, so they have a high allocation to US. So we have hedged some of that. And the weakening in the US dollar has predominantly been driven by policy uncertainty. So this has been driven by the Trump administration. They're doing things that people wouldn't naturally see as normal, and therefore that policy instability is weakening the currency. One of the positions we sold was a fund called GQG Partners US Equity, and these are really good managers, and they have delivered good performance for the funds. But this year, what they've done is they've taken more of a defensive positioning within the portfolio. So they've reduced down their tech quite aggressively, and they added into energy. And we just felt, look, that positioning, we don't really strongly believe that that's going to drive a good outcome for the portfolio. And I'll talk about tech and tech valuations in a bit, but what we're seeing is the earnings are still coming through from the big tech companies. So we did remove that fund from portfolios. And just a little bit on government bonds. So government bonds which are really long in duration or which have been issued for a longer period, we've taken some of those out of portfolios too. And a lot of that is just around political risk. So next year, it'll be a US midterm election. And in the UK as well, you have some recent political risk. So there's concerns about maybe a change in leadership in the Labour Party, which you'll start to see in the press quite soon. So from our perspective, just removing some of that risk from the bond side of the portfolio. So what I'm going to do now is just give you a bit of a macro view and outlook. So I'm going to cover off some of the key themes during the month. So one of those was the unreliable data. So we've seen some really quirky data prints coming out in the US, and some of that's been driven by the fact that you had this government shutdown, and I'll talk through that and why that's important. Then I'm going to talk about moving to this transactional landscape, and this is more about the Trump administration's approach, and then other governments following that approach, and then what to expect as we move into next year ultimately. So this is really centered around a Bureau of Labor Statistics. So basically, this is a entity in the US which collects information and then provides information on unemployment. And the interesting thing for me was that they came out and said, look, actually, the figure which we have told you, we want to revise it. So we're going to update it. And the reason we're updating it is because we got it wrong by a lot. So my first thought there was I really want to understand how they're collecting this data, to understand why it was so wrong in the first place, because often, the market can react to data points. So it's important for us to understand what those data points mean. So we did a little bit of digging, and ultimately the Bureau of Labor Statistics, they gather unemployment data from companies and people who fill out surveys. And the first interesting point is that they collect that information over a 3-month period. So let's say they're gathering the unemployment data for September. They're getting the data in September, October, and November. And why is that? It's because if the people who fill out that information can't fill it out in September, maybe they can do it in October and November. And they might do that for several reasons. So those reasons could include the fact that, the data itself, when they're collecting it, they might not be able to publish it or put that information in because they could have maybe their company earnings are coming out, or maybe they're launching a new product. So it just shows you that you're not getting all of the data responses coming through when you would expect them. The second thing that we found quite interesting was that the method which people use to basically collect that data is very different. So some people go onto a portal and fill out the information for the survey. Some people telephone it in, and I was very surprised to see that they still accept some survey entrants by fax. And it just goes to show you that basically the Bureau of Labour Statistics hasn't really kept up with the times. And a lot of that is to do with funding. They're not getting enough funding from the government, so federal funding. So we found that was quite interesting. And then I think on the next slide here really highlights that the number of people who complete those surveys is deteriorating. So generally, the response rate when they send out these surveys is about 75%, but over the last couple of years, it's continued to decline and decline and decline. So less people are actually completing the surveys. So what it means is that the data points that you're getting, they're kind of a shorter sample period, so less people completing it. So what these entities do is then they make up the rest of the numbers. They give you an average or come up with their own way of just filling out that pot, which again just means that the data itself loses its integrity. And the other interesting point that we found out was that people who are completing the surveys are ultimately skewed towards people who are older. So you've got people who are aged 60 to 75 completing more of these surveys, and people who are aged 30 to 45 completing less. So the demographic is changing for people who complete the surveys. And I know very well that if you ask my dad for his view on the economy versus me, we'd have two very different ways of thinking about it. So it just means that you're getting some bias in the data. So what's the point? The point is that you get these data points and then markets react. Markets create a story out of every single data point that comes out. And can you imagine what happens when the Bureau of Labour Statistics comes out and says, look, actually, the numbers which we have been telling you about unemployment, they're out, and we have to revise the figure. How much are you revising it by? 1 million. So the market's general reaction to that would be, US is heading to a recession because the job numbers are much worse than we thought they were. But to me, this is more about data and the collecting of the data. So they've got a problem with the data itself. So we would never react to one data point. What we tried to do is identify a trend, something which is trending over time, to decide whether or not that's something worth actually making a change in portfolios to. And then also understanding how they gather the data also allows us to decide whether or not it's something which is important or not. Is it a real thermometer check of what's happening in the economy? And because this year you've just had so much involvement from the US administration and then government shutdown, it means a lot of the data points are quite noisy. So again, it's just not to overreact to the headlines. So that's the kind of key takeaway there, which often fill the media because often the information that they're purporting is actually incorrect. So it's not giving you a true visual on what's actually happening. So the second section is called Transactions Speak Louder Than Words. And this is more due to the Trump administration and their kind of involvement at a business level. So they've been getting more involved in driving business decisions and orchestrating business deals between companies. And NVIDIA would be a great example of this, where there were deals with Oracle and OpenAI and people questioning whether or not AI is in a bubble. That's the big question over the last quarter. And what we've done is we've looked quite closely at NVIDIA and we've compared it to companies back in 2000. And ultimately, NVIDIA's share price has gone up a lot, but its earnings have also gone up a lot too. And when you compare it to companies back in 2000, basically what you saw then was their share prices went up an awful lot, but they didn't have any earnings to support that move in their share price. So when those earnings didn't come through, you saw the share prices come down a lot. But that's not really the case for the tech companies today. So the other thing I'd highlight is that a lot of people are calling the Magnificent Seven or the big tech companies in the US AI companies, but they're not really AI companies. These are big companies that generate revenue from very different things. So Tesla sells cars, Microsoft sells software, Apple sells phones and hardware, computers. You've got somebody like Amazon, they just sell goods. So it's like a big shopping company, a big supermarket ultimately. So these companies are all doing very different things. Google sells online search advertising for searching online. So they're not AI companies, but what they're doing is they're taking some of the revenue they're making, the several billions that they're all making, the cash on their balance sheet, and they're investing in a new technology, which is artificial intelligence. And as part of that, they need to build data centers to process information more quickly, and they're buying NVIDIA chips. So NVIDIA is benefiting from these companies spending their cash. Now, all of these companies are just spending in a new business stream. And ultimately, it just means that they're looking to create a new revenue stream for their business. So in a sense, they are not AI companies. They're just trying to generate a new revenue stream for their existing businesses. So I think the market has kind of obviously created this narrative, false narrative about what these companies are, calling them AI companies, when they're just investing in this new revenue stream for growth. So we're less concerned on that side. And ultimately, you have seen the share prices of some of these companies rise quite quickly over a short period of time. And our expectation is you'll start to see what we call consolidation. And that just means that the share price will probably trade sideways for a bit as people wait to see more of those earnings come through. And that's natural. It often happens in the cycle, particularly around the middle of the cycle. So we would see this as this mid-cycle consolidation phase. And you have to remember there's lots of other things happening which will be quite positive as we move into 2026, but I'll come on to that. So we don't think we're in an AI bubble at all. We think these companies are not AI, firstly, and they're generating revenue from the businesses that they're invested in. Plus, they're investing in this new area for growth, which is AI. Now, one of the other things which people talked about this year, particularly after Liberation Day, was the fact that, look, this is going to be really bad for Asia. And what this chart shows you here is it shows you trade coming from China with the rest of the world. And the reality is that that line is moving up. So trade from Asia globally is increasing every year. So it's not decreasing. So tariffs haven't had any kind of really material impact on that trade. And it's getting bigger because China and Asia are trading more closely together, and they're brokering deals, to benefit the region, Asia itself. And what that really shows you is that we're moving to this kind of transactional world. So Donald Trump has really set the tone. I want to really focus on business and business deals. And in Asia and China, they're thinking, well, actually, we're going to do exactly the same thing. So you're moving to this world where people are very focused on driving growth for their own economies. That'll be the big focus. And really interesting that, Europe will then also have to look at ways of driving growth. And one of the ways they'll look to do this is by spending on defense. So we can see that defense spending in Europe is going to increase rapidly over the course of the next couple of years. A lot of this, obviously with a view on Ukraine and building up Europe's defenses, because if Europe is less reliant on the US, it'll have to be able to support itself. So therefore, it needs to spend on defense to get to that level. So, Europe reckons it'll take 3 to 4 years for it to be in a position where, it could defend itself militarily should it need to. But what that does do is it does drive economic growth because it sends money to the defense sector that creates jobs, creates growth in the economy. So there's expected to be a big portion of spending here. But just again, another example of a region looking to be a bit more transactional and to create growth for that region. So you can see where we're moving to. Okay, So what next? I just have a chart on inflation here, and you can apply this chart to anywhere, whether this is UK, South African, US, etc. The key theme is the same, is that, inflation is continuing to come down from very high levels. And, some of the more recent inflation figures, particularly in places like the UK, have been driven by some food price inflation recently. And so it's seen a little bit of a tick up. The point there is that people react to any kind of slight increase in inflation and think, oh, this could be bad again, because they're thinking about the big spike in inflation that we had post coming out of COVID and supply chain disruption. We were very much away from those highs, and inflation is trending down. But any kind of slight change in that data, and people are very twitchy when it comes to looking at that. But we don't think that is a real problem today. So we do expect inflation to continue to come down, because a lot of the inflation that we had post-COVID was driven by goods. People were buying goods in their homes. And then when people were let back out, it was all about spending on services. And we're seeing the prices of both goods and services continuing to come down. It's going to be a bit of a global theme. So we think that that's actually a good backdrop as we move into 2026, because that really feeds into government bonds. And again, this is showing the UK, but again, you can apply this to anywhere, whether that's the US, etc. But the level of interest that government bonds are paying is quite high. But if inflation comes down, that number can come down too. So we just had the budget here in the UK, and everybody was talking about UK debt. So if interest rates in the UK are 4%, and you're buying a 10-year government bond, which is paying you a little bit over that, there's not much additional in that price. So the little bit additional in that price is really the risk around inflation for lending your money to the government for that period of time. So if that spread was really, really high, it would mean that, look, there's a lot of risk baked in case I don't get my money back. So that level there is not telling me to be concerned about government bonds, because it's very close to what the rate is I can get in my bank account. And then the extra bit's inflation or the risk that I don't get paid back. So I think that markets were overly concerned about that. And I think that concern subsides. We've had that concern in the US as well. That comes down as we move into 2026. Why? Because inflation comes down. And with that, interest rates come down. So a lot of talk in the US about trying to get interest rates down this year. Donald Trump has been very vocal about this. And we've started to see the US central bank begin to cut interest rates again. And we're seeing that also in the UK. Europe has paused, but they're pretty low. But you're also seeing that in South Africa, your inflation is coming down. And with that, as the inflation comes down, it allows interest rates to come down too. So we expect that theme to kind of drive through markets for 2026. So we think that that's a real positive. Now, the other things to keep an eye on. The other thing to keep an eye on next year is that we have I think there's just a problem with the audio, so you might have to edit this bit out.
Yeah, I was going to say maybe go back and then we can splice the two together.
Yeah.
Is it back on? The part we lost you on was just before. It's back on. And the part we lost you on is where you said the other thing to look out for.
Okay.
Perfect. So maybe just start with that.
So the other thing to look out for this year, and particularly as we head into 2026, is the midterm elections in the US. And this is going to be a very hot topic. So the reason people will focus on it is because there's a likelihood that the Republicans lose some of their power in Parliament. So you've got the Congress, which is made up of the House of Representatives and the Senate, and the Democrats and the Republicans both control bits of that. But the Republicans have been in control of both of those houses of Parliament. And the expectation is maybe they lose some of those seats and lose some of that control. So the market will be very much focused on that next year. So what it means is that the Trump administration will look to put in place some voter-friendly policies as we move into 2026. So that'll include things like trying to ensure that voters are happy. And one of the ways they will do that is by looking to implement some tax cuts. And if you think about it, tax cuts generally benefit businesses too, because if you're implementing tax cuts to improve the consumer's outlook, then that's going to help companies because they'll have more money to spend. And there also has been talk about using the money generated from tariffs to send checks to people, to give people kind of tariff relief checks. And again, where will that money end up? Likely in the stock market and likely in those big companies too. So just something to be aware of. But we will be focusing on that as we move into 2026, the US election and what that means. Now, I'm conscious that obviously I've covered quite a lot this morning on markets, but what I'll do is I will just go through positioning in portfolios. So we've talked about our central case and what we think is likely to happen, and ultimately we see kind of growth is coming off a little bit. It's not falling materially at all, but inflation is coming down, which is really positive, and we're expecting those gradual interest rate cuts to come through, and a few more maybe in 2026 because of a change in the Fed. So in the US, the central bank is going to change the person who's in charge of the Fed or their central bank, and they'll be expected to lower rates because inflation is coming down. And that's generally a positive backdrop for equities and bonds, but really bad for cash as those cash rates get lower as interest rates come down. Now, what if we're wrong? If the economy is worse than expected, people have been talking about this for quite a long time, this recession, and everybody thought we were going to get a recession back in Liberation Day. And some people have made knee-jerk reactions and sold out of markets. And obviously that hasn't been the case. The economy has been fine. So we are watching things like the jobs market, but we're also being aware that we're looking at the right data points, not the data points which are noisy or inaccurate, and not reacting to those because we're not really seeing any signs of any stresses to date. On the next slide is just a little bit more granular level detail. So some of the key things that we're looking at in portfolios. We've talked about the fact that inflation is likely to ease and come down, and the economy is holding up better than expected. We've seen markets rebound, but climbing this wall of worry. But we do expect that to continue because there's a number of reasons to be positive as we do move into next year. Government bonds are looking a lot more attractive today because you're being paid a higher rate. And with inflation coming down and interest rates expected to come down too, that tends to be good. We like bonds in emerging market countries as well. So we're seeing some good returns coming from there. And we also like infrastructure, which benefits from rates coming down. So you think about infrastructure, an infrastructure project, building an airport. How long does that take? Quite a long time. So therefore, you need to secure financing for a long time. So if interest rates come down, your financing costs drop too for that long-term project. So that's usually a positive for infrastructure. So with an asset class view, we think government bonds are attractive. We like infrastructure within alternatives, but we're neutral on equities. We're not really concerned. We think the market has got that one wrong in November around the AI bubble. And you saw that little bit of nervousness only for the market to come back strongly towards the end of November. Japanese equities we like. So we've gone overweight Japanese equities. You've had a change in prime minister. You have real policy for driving improved profitability in those companies. So there's a real focus for the government and corporates to try and generate more profits. And there's lots of things which they can do. So they're calling it corporate reform. So there's lots of value to be unlocked from companies there. So hopefully that gives you a little bit of a flavor on some of the different themes within portfolios, but where that leaves us is that neutral on equities, neutral on bonds, overweight alternatives, neutral on cash. And ultimately, this is just a look through into portfolios and how they're positioned. So we've got the 4 different portfolios: defensive, cautious, balanced, and adventurous. You can see the exposure to US equity across those portfolios. So defensive at 16%, up to adventurous at 50%. But you can also see that you're getting diversification too. So some people are concerned about the US and performance has been really good, but you have to remember there are other drivers to portfolios too, particularly the portfolios that we manage on your behalf. And you can see Asia is 12% at the top end. You've got Europe up at 13%, UK again 9%, which is a little bit more than some portfolios, but UK has been really performing quite well this year. And Japanese equities, we've really recently been adding to that. And you can see the exposure to alternatives, but we've only have a small exposure there to infrastructure in portfolios. But you are getting diversification, which is the key points on that. And on this slide here, it's just giving you a little bit more of a look through into some of the positions within the portfolio. So you've got examples there, like the M&G Asia fund. So this has been one that's actually performing quite well this year. So we've seen some good performance coming from there. And I mentioned the fact that Asia tech is performing a lot better. So it has been a real surprise for the investment community how far ahead Asia is when it comes to technology. And actually, in some instances, are they behind the US or ahead of the US when it comes to this new AI models, or whether it's electric cars, the BYD versus the Tesla? BYD's faster and cheaper. So you can see that they are gaining an edge in some areas like that. So seeing some good performance coming through from there. But pretty pleased with the performance of the underlying funds. Also, the Bailey Gifford Japan fund, some good performance from that fund too this year. And I mentioned kind of Japan and some of the reforms that they're bringing through. And the next slide just covers off some of the fixed income elements. So this is the bond positions within the portfolio. So the Man Global Investment Grade. So this is Man Group, and they've delivered really, really good performance over the course of this year and last year. So that fund has done really, really well. Whereas you have Artemis Corporate Bond, it's more of a steady fund delivering performance above the benchmark, but again, they've done really well. So that's one by a guy called Steve Snowden, but he's got a really good team in place, and they've delivered some strong returns too. So I'm going to stop there because I appreciate I've covered off a lot. And yes, apologies, we did have somebody knocking on the door middle of that, and one of my colleagues had to walk through and get that. So yeah, apologies for that disruption on the call.
Great, Nathan, thanks so much. And thank you for the insights and comprehensive overview. As always, your perspective on the macro environment, asset classes, and positioning within the Marlborough multi-asset range is incredibly valuable. So really appreciate it. For our clients, if you have any follow-up questions about your portfolio, please do reach out to your advisor. They'd be more happy to engage with you after the session. So we'd encourage you to please reach out so we can ensure your financial plan remains aligned with both market conditions and your long-term goals. The slides of today's presentation will also be shared with you for those who are interested. And lastly, on behalf of Carrick Wealth, thank you for your time and engagement today. Nathan, thank you once again for sharing your expertise. We appreciate your continued trust in Carrick and look forward to supporting you through another productive quarter ahead. So have a wonderful day further. Thank you.
Thank you.